You've heard it on the news every single night. The S&P 500 was up 20 points today. Or, the S&P 500 fell into a bear market. It's a magic number that seems to control the entire financial world. But what is it? Is it a stock you can buy? Is it a government agency? The truth is, understanding this one simple concept is the key to unlocking a proven, simple, and incredibly powerful investing strategy. In fact, the most famous investor in history, Warren Buffett, has said that for most people, it's the only investment they will ever need. Today, we're demystifying the S&P 500, and I'm going to show you why it might be the most important investment of your life. So, let's start with the basics. What is the S&P 500? The S&P 500 is simply a list. That's it. It stands for the Standard & Poor's 500, and it's a list of the 500 largest and most influential public companies in the United States. Think of it like an all-star sports team for the U.S. economy. You can't just join the S&P 500. You have to be invited. A special committee at Standard & Poor's decides which companies get to be on the list. They look for big, stable, profitable companies that are leaders in their industry. This list includes all the names you know and use every single day. Companies like Apple, Microsoft, Amazon, Google, Tesla, Coca-Cola, and Johnson & Johnson. When you look at the S&P 500, you are looking at a snapshot of the 500 companies that are the engine of the American economy. So, why does this list matter? Because it's the single best report card we have for the entire U.S. stock market. When you hear on the news the market is up today, they are almost always talking about the S&P 500. If the 500 companies on that list are, on average, worth more today than they were yesterday, the S&P 500 goes up. If they are worth less, it goes down. It's the simplest way to know, in one single number, how the biggest companies in America are performing. When a major event happens, like a new technology is invented or a pandemic hits, investors watch the S&P 500 to see how the market reacts. It's the benchmark. It's the standard that all other investments are measured against. But here's the most important part. You don't just have to watch the list. You can invest in it. Now, you can't literally buy the S&P 500. It's just a list. And you definitely don't want to try and buy all 500 stocks one by one. You'd need millions of dollars. So, how do you invest in it? You do it by buying something called an S&P 500 index fund. An index fund is a brilliant invention. It's like a basket that holds all 500 stocks on the list in their correct proportions. When you buy one share of an S&P 500 index fund, you are instantly buying a tiny fractional piece of all 500 companies at the same time. These funds are typically sold as ETFs, or exchange-traded funds. You might see them under ticker symbols like VOO, Vanguard S&P 500 ETF, SPY, SPDRS, and P500 ETF, or FXAIX, a Fidelity Mutual Fund. These are the keys that let you unlock the power of the S&P 500, and they are the single most popular investment in the world for a reason. There are three main reasons why this is such a powerful strategy. First, instant diversification. In our last video, we talked about building a 3 ETF portfolio to diversify. The S&P 500 is the core of that strategy because it is itself an incredibly diversified fund. If one company on the list, let's say a big airline, has a terrible year, it doesn't really matter. Your investment is held up by the other 499 companies like Apple or Microsoft that might be having a fantastic year. You are not betting on a single company. You are betting on the entire American economy. This protects you from single stock risk. If you had all your money in one company and it went bankrupt, you'd lose everything. With the S&P 500, that's practically impossible. You are diversified across every major industry: tech, healthcare, finance, consumer goods, and more. Second, it is a self-cleaning oven. This is a brilliant automatic feature. Remember that committee that picks the companies? They also remove companies that are no longer successful. If a company starts losing too much money, gets acquired, or simply becomes irrelevant, it gets kicked off the list. A perfect example is a company like General Electric. It was a giant, an original S&P 500 member. But as it struggled, it was eventually removed. When a company gets kicked off, it's automatically replaced by the next big, successful, up-and-coming company. Think about companies like Tesla or Nvidia. They weren't on the list a decade ago. But as they grew and became dominant, the S&P 500 committee added them, and a less successful company was removed to make room. This means your investment is always rotating out the losers and rotating in the winners, all without you having to do a single thing. You automatically sell your shares of the failing companies and buy shares of the future superstars. It's an evolutionary mechanism that ensures your investment always represents the current 500 strongest players. And the third and most important reason, proven, historical returns. Over the last 50 years, the S&P 500 has had an average annual return of around 10%. This is including all the scary crashes you've heard about. The 2000 dot-com bust, the 2008 financial crisis, the 2020 pandemic crash. Through all of that, the S&P 500 has continued its unstoppable march upwards. This is because you are betting on human innovation, capitalism, and the long-term growth of the economy. A 10% average return is powerful. Thanks to the magic of compounding we talked about, every $1,000 you invest could double to $2,000 in about 7 years. This proven, long-term performance is what makes it such a reliable wealth-building machine. This is why Warren Buffett, one of the greatest investors of all time, has given this simple instruction for the money he's leaving to his family. Put 90% in a low-cost S&P 500 index fund and 10% in short-term government bonds. He's not telling them to pick stocks. He's not telling them to time the market. In fact, Buffett famously made a 10-year, million-dollar bet against a group of high-paid hedge fund managers. Buffett bet that his simple S&P 500 index fund would outperform their expert stock picking. After 10 years, it wasn't even close. The S&P 500 crushed their performance. Buffett's point was simple. Trying to beat the market is a fool's game. The smart money is on owning the market. He's telling his family to buy the report card, to bet on the entire US economy and let it compound for decades. So let's put this all together. What is the S&P 500? It's a list of the 500 biggest and best companies in America. Why does it matter? It's the report card for the entire US economy. How do you invest in it? By buying a single, low-cost S&P 500 index fund, like VOO or SPY. When you do this, you are instantly diversified across 500 companies. Your investment automatically cleans itself, selling losers and buying winners. And you are tapping into a powerful wealth-building engine that has historically returned an average of 10% per year. It is the simplest, most proven, and most recommended starting point for any new investor. It is the very foundation of the 3 ETF portfolio we're building. And for many people, it's the only investment they'll ever truly need. If this video helped you finally understand what the S&P 500 is, do me a favor and hit that like button. It's the best way to tell YouTube that we're making high-quality, simple content for beginners. And be sure to subscribe so you don't miss the next video in our journey. Now, for my question, before this video, what did you think the S&P 500 was? Be honest and let me know in the comments. I'm always curious to hear. Thanks for watching, and I'll see you in the next one.